Okay, we have been talking about the cost of carry formula, and we said for an investment asset this equality holds. For a consumption asset, inequality holds like this. And then we could make this inequality into equality by introducing the concept of convenience yield. Okay, convenience yield y. So every time the cost of carry formula does not satisfy equality, then there exists convenience yield. Okay, convenience yield is nothing but something that makes this inequality into this type of equality. And it can be said with convenience yield y, the future price is below or under full carry. That means for investment asset, future price is always equal to full carry. So it is only consumption asset that has that is below full carry. Okay, that has convenience yield that makes below full carry. Note that in this below full carry situation, future price or forward price is going to be lower than S0 times ECT. In some cases, future price is so low, cash price could exceed future price. Now this situation is called backwardation. So backwardation is the situation where future price is so low and cash price or spot price exceed future price. Okay? So this is cost of carry formula, and there is an alternative to cost of carry formula, that is the expectation theory in determining future and forward price. Suppose K is the expected return required by an investor on an asset. We could invest F0 times e to the negative RT now. Then on maturity time t, this will grow to F0. That means this one imply that you buy a futures contract with future price F0 now. So to make this F0 on maturity date, you're gonna invest this much now. Then with this investment, you're gonna get ST. You're gonna get underlying asset, but on maturity date, that's gonna be priced as T. Okay? If that's the case, since we do not know how much underlying asset will be priced at time T on maturity date, you only have to expect it now. So the current value of your underlying asset is going to be this, assuming that K is the expected return required. Okay? Now, in a well-functioning market, this investment, the net present value of this investment has to be 0. That means F0. If you arrange this this equation, it's going to look like this. Okay. Now, from this, we could say if K is equal to R, That's the case when we don't have systematic risk. Then F0 has to be equal to expectation of ST, which means that F0 is an unbiased estimate of ST. Normally, K is going to be greater than R. That's the case where we do have positive systematic risk. Then F0 is going to be lower, less than expected value of ST. That's the normal backwardation situation. But sometime K could be less than R. That's the case of negative systematic risk. If that's the case, F0 is going to be greater than expected value of ST. That's the case of contango. Okay, I like to elaborate this normal backwardation and contango theory a little bit further. That's the next screen. Here, risk aversion plays a role. In a normal case, where this risk aversion is related to, the K. According to CAPM, K is going to be determined in the following way. K is going to be risk-free rate R plus some risk premium. Okay, so in normal case, K has to be greater than R. That's the normal backwardation. But if I elaborate it, that's the case where hedgers needs to be short to avoid unwanted risk and is willing to sell futures contract at a price below expected future spot price. Now that's going to induce risk-averse speculator to accept the long side of the contract. From this view, the hedgers buy insurance from the speculator, and in so doing they transfer their unwanted risk to the speculator and pays an expected profit to the speculator for bearing the risk. This is the normal backwardation situation. The view that if future prices tend to rise over the contract life due to the hedger's general desire to be net short is known as normal backwardation. Okay, think of this as a normal case where this is happening. Okay, but sometime this could happen too. This is contango situation. This is a case where K is less than R. And if I elaborate it, that's the case where hedgers are net long and future price is going to be lying above the expected future spot price. So the price of futures contract fall over its life. And this pattern of falling price is known as contango. So if I graph it, this is contango situation. This is normal backwardation. And this dotted line is the case where future price is going to be equal to expected future spot price. Now this net hedging is a hypothesis. To begin with, start from a normal backwardation situation, but then so hedgers are net. Hedgers are those who taking a short position, but later they take a long position. Since next time we're going to talk more about this hedging, maybe we could talk. We could have a better understanding once we're done with the next class. I'm going to stop here.